Greetings and welcome. This is results-oriented preparation. I'm Kenneth, and in today's video, we are concentrating on financial management versus accounting. In the previous content that we have generated on this platform, we have been attempting to help recently graduated matrics with their career choices. So in this video, we continue doing that, but with a specific focus on those that are pursuing a career in financial services and financial management. You'll notice that accounting and financial management are amongst the two most pursued careers in that area of financial management and financial services. However, they are not the only ones. But for the purposes of this video, we are going to concentrate only on those two. But before we go ahead, please help us with liking, sharing the video, and subscribing if you have not yet subscribed to this channel. Also, hit the notification button so that you can maybe notified as and when we bring new content, so that you'll be the first to see that particular content. Accounting and financial management. Accounting focuses on the recording and also on publishing financial statements. The primary function of accounting is to provide data for measuring the performance of a firm. To do that, financial accountants, or accountants in brief, will always look at recording and summarizing financial transactions in order to generate financial statements. Now, for these purposes, the reason why we are concentrating on this type of content is to help you understand that if you want to go into a field of accounting or to go and study accounting, you need to deal with such things. Oftentimes, you have found people starting a career, going to tertiary education, and then during the first or second year, they drop out. It's because they did not know what to expect, all right? So we're helping you to manage your expectation, and with those expectations to find out for yourself now before you start whether this is what you want to do or not. Now, if you're doing accounting, as I said, in developing those financial statements, you are going to concentrate on recording as well as summarizing financial transactions of a business. The two main financial statements are income statements as well as statement of financial position. Now, an income statement, it reflects the firm's performance over a given period of time. It could be quarterly, it could be half year, it could also be annually. But for most income statements, especially for public companies, they will do that half year as well as annually. The statement of financial position reflects the position or the financial position of the firm at a point in time. For example, today being the 31st of January 2022, the statement of financial position will reflect where the firm stands at that particular point in time. So it is at a point in time as opposed to over a given period of time. So that is what the financial accountant does. There is always this confusion with people going into the field of finance. Some think that financial management and accounting are the same. Though the two are related, they are not the same. Financial accountants provide the information that financial managers need to make decisions on a day-to-day basis. So, though they are related, they differ. The difference, therefore, is that one is involved in recording and summarizing, which is accounting, while financial managers use what the accountants have generated in form of records and then using that for the decisions that the business have to make. Financial management is based on a number of principles, but for our purposes, we're going to look at three main principles. The first principle is called the cost-benefit principle. Now, the cost-benefit principle is what financial managers use when they make decisions about projects, whether to go ahead with a particular project or not to. All right? So the cost-benefit principle compares the cost relative to the benefits of a particular project. Now, if the costs outweigh the benefits, then that project will not go ahead. But if the benefits are greater than the costs, therefore, the financial managers give the go-ahead for that project to be pursued. Principle number 2 is the risk-return principle. The risk-return principle is also used in investments. You have heard oftentimes people saying that the higher the risk, the greater the return. Although this is true, it might also not be true for other cases. So financial managers use this principle to balance the risk based on what is expected in terms of return. Therefore, what it means is that if they know the risks that are attached to a particular investment, they can hedge those risks to make sure that they get the utmost return out of that particular investment. Although sometimes if the risks are too high, then the financial managers can make the decision not to go ahead with such an investment. Therefore, it is important to know the balance between risk and return. And then the third principle is called the time value of money. Now, the time value of money can be split into two particular values, which is the present value as well as the future value of money. Now, the future value and the present value of money are affected by other external environmental variables such as interest rates as well as inflation. Therefore, for financial managers to make their decisions, they need to know the present and the future value of money. For instance, in making a decision to invest, the future value of money as far as the cost of the money that would have been financed in terms of the interest rates that will be attached to, for example, money that has been borrowed or to loan repayments, will help them make decisions either to pursue a particular type of financing or not. Or it might be used for valuation purposes. For example, if you have got shares in a particular blue chip company, you know that after a given period of time, the value of the shares or the future value will be this much. Okay, so looking at that future value, you can now then calculate whether it's going to be a valuable investment or not. If you factor in things such as inflation, you will then see that either inflation is too high to erode the value of that money, therefore making that investment not a good investment. Or if inflation is manageable, for example, in South Africa, we've got inflation targeting within the ranges of 3 to 6%. Then if the future value will be above that 6%, then it means that we know that this is an investment that is valuable. So it is important to know such things, that if you're going to such a career, you are going to encounter these things, and in doing so, this helps you make that particular decision whether to pursue it or not to. Other reasons also for financial managers to use the perceived future value of money is to help them with working capital management decisions. In doing so, they know exactly what is needed, how to source it, where to source it, and as a financial manager, you are using primarily, like I said, the information that has been generated by the accountants to make those decisions. If this content has helped you, please do subscribe or like, share the video. Otherwise, I hope that this information will be key and very valuable in helping you make that particular decision to go into a career that deals with financial services, or to go into a career that deals with accounting as well as financial management. This is results-oriented preparation. We'll see you in the next video.